Very pleased to welcome back to the show Aaron Dunn, KeyStone Financial, KeyStocks.com rather, KeyStocks.com, KeyStone Financial. Aaron, great to have you on with us.
Great to be here, Michael.
I got to tell you, a little bit of an ulterior motive for me, as you might have heard earlier, talking to Mike Levy about one of the things trying to inform people about is that while our bank rate is sort of a will they won't they drop it, in this point, and they haven't, but the bond market has dropped down. So we've seen yields drop down. And I know that you guys just did this massive report, the Canadian Dividend AllStar report. I know you guys just completed it. And of course, that's what I love about KeyStone Financial is you do so much research, and it's exactly what we did. I mean, I read that you had gone through every security listed on the Toronto and TSX Venture Exchange, and then you take out all the dividend and income paying ones.
Yeah, absolutely. That's what we do. So you're looking between the two exchanges, about 3,700 companies. We narrow that down, first of all, to the dividend paying universe of about 350 companies, and then we look through every single one of those businesses. And we like to do that a couple of times a year, but we just put out our Dividend All-Star report last month in June, and that's essentially the culmination of all of that research, going through every single company. So going through doing the first round of research, we were able to narrow the field down from 350 to about 70 companies. And these are companies that are paying a dividend, growing their dividend generally, and just doing well. They're growing their businesses. They're not trading at excessively high valuations, and they have solid outlooks going forward. But then we drill down much deeper into that, and this is really where the work starts. Is we want to reduce that list down to a more manageable number. So about 30 companies out of that 350 fit for our top tier monitor list. So these are the best in breed businesses. And then out of that, we drill even deeper, and we recommended in our All-Star report a portfolio of 8 dividend stocks. They were essentially, some of them are conservative large cap dividend companies, all the way down to smaller cap, higher growth dividend paying companies. But what we really consider to be the best in breed and a great way to start a dividend portfolio.
Well, I'll tell you one that I'm going back to the World Outlook Conference where you and Ryan spoke, and one of the ones that you were talking about was Microsoft. So I had another look at it, of course, Friday on the close, and you're up over 30% on that alone.
Yeah, Microsoft is. We really liked it when we recommended it at the conference. It's funny because after I talked about it at the World Outlook, somebody came up to me and said, "What are you recommending Microsoft for? It's this big business everybody knows about." And a lot of times we recommend companies that nobody knows about. They're completely unfollowed businesses. But when we can find a great business like Microsoft at a reasonable price, the company, it doesn't need an introduction. It's a software business, but most people just think of Microsoft as Office products and Windows, but really they're much more than that. Double-digit growth it's been generating, and what we really love about the company is that it's a defensive play. So it's a type of software company. While it's growing, it's also very well situated for a situation where the economy were to contract. So very well entrenched in its different areas. It's increasing its recurring revenue, so it's shifting from just a one-off license sale type of business model to a renting their software and getting that recurring royalty fee, which is a great way to earn money. But what really attracted us to the business is that they're killing it in the cloud computing space. So they have their cloud computing platform, Azure, and cloud is a huge theme in enterprise right now, double-digit growth for the market overall. And Microsoft is absolutely killing it there. So it's the second largest cloud operator right now, growing its market share over the last year at the fastest rate, so increasing market share in a high-growth industry. And in spite of all of this, we thought it was trading at a very attractive valuation, or reasonable valuation of about 25, 27 times earnings. So as you said, the stock is up about 30% since we recommended it at the Outlook conference in February, but we still do like the company long term. It's trading right now at about 30 times trailing earnings, which is not what we would consider a cheap valuation. But when you look at that relative to other U.S. tech companies that have similar fundamentals, similar growth, strong balance sheet, we see valuations of upwards of 30 or 40, 50 times and above earnings. So we still, even at this price, think that for long-term investors, Microsoft is a very reasonable choice.
Well, I like the part that it's up 30%.
Wow, of course we love that, and hopefully we'll have this conversation a year from now and we can say that again.
Yeah, there you go. But it's an example of the stocks you guys follow. In terms of this, though, that the other thing I've always liked right from the get-go at Keystone Financial is you say, okay, this is aggressive, this is ultra-conservative. You quantify exactly what place it holds in your portfolio. And that's why, by the way, and as I said, I saw that you guys had done your AllStar dividend, 2019 dividend AllStar report, which looked at the Canadian dividend market, saved me a lot of time. This is why I always say this is the best of research. Yeah, I could look at, I have the background to look at 3,500 companies. Do you know what I mean? I don't have the time. I love it that you guys do it. You have the expertise. And now I get to just look at, you've got 8 recommendations. I find that a lot easier for me. But, so it's such an important time now. I was just talking to Mike Levy about, the lower interest rate environment. Is that made the kind of stocks you're looking at for dividend growth, quality yield, that kind of stuff, more difficult to find because everyone else is out searching? Or are we still at a place where it's not too bad a time to go out there and say, well, I'm not going to take 2%, in my 5-year bond. Instead, I'm going to look at a dividend pair.
In terms of where everybody is searching right now, just where we are in the cycle, I would say that growth stocks, pure growth stocks, are actually more in vogue right now than dividend pairs. Dividend pairs really kind of they come in and out of fashion depending on where people's expectations are of interest rates. And we've seen interest rates kind of come up and go down. Repeat that several cycles over the past 8 or so years. So we're not really too concerned about following the up and down movements. We're really looking for companies that can produce over the next 3-4 years and beyond. And when you're looking for high quality companies in the dividend space, you really want to focus on companies that what we would call growth at a reasonable price, as opposed to just looking for low valuation companies or pure value investing. The companies that we would recommend, they're typically not trading at rock bottom prices because they are strong, successful businesses that are growing a nice yield, but we also don't want to overpay. So we're looking for companies that are kind of in the mid space between, really, high profile, high valuation, expensive businesses and companies that nobody cares about. So, that's essentially what we're looking for. And we are still finding those opportunities. You have to be selective. You can't just take a shotgun approach. And one thing that we also say is never chase yield. There's a lot of companies out there that are providing very nice yields and are growing those yields, but they're not necessarily the most robust businesses. So you could definitely see some of these companies getting into problems or having some poor financial performance down the road, and your 5-6% yield can be wiped out quite easily. So we're definitely take the approach of looking for quality over just something that's cheap or something that pays a nice yield. And certainly, the fact that we were able to recommend a portfolio of 8 solid companies diversified between aggressive risk category and conservative risk category shows that there are still some businesses out there, and some of those are underfollowed and not very well known, whereas other ones are larger, more stable, long-term companies. But I remain relatively optimistic on what we're able to do going forward. And of course, we're looking in Canada, we're looking in the US, we're really looking all over. So we are able to find those companies. You just have to spend a lot of time digging deep and really drilling down into what those companies are doing, and not just taking face value the press release or the financial statements, but really understanding the business models and understanding where the company is heading down the road in the future.
Aaron Dunn's here, Keystone Financial. Hey, I just want to say, they just in this report, it's called the Dividend AllStar Report. And what they did is they took the entire universe of Toronto Stock Exchange, Venture Exchange companies. Then they pull out the dividend payers. And then they say, okay, well, which one of these are real businesses here? So they got from 3,700, they get down to 352. Then they start putting their own methodology against it, their own evaluations, which has produced terrific results. And they got down to 31 stocks. That's their top tier that we should be looking at. And then they recommended 8. Based on growth or financial stability, income generation, all of those kinds of things. And I don't think Aaron's aware of this, but we phoned his office because this report normally goes for $1,400 $1,400. And again, if you think of it, if you're about to make an investment, that's not expensive because you got to get in the right ones. But we've got a 2/3 discount on that for Money Talks listeners. So all I'm asking you to do is go to keystocks.com, click on it there. Right there, you can see the Money Talks offer. Aaron, you can do that right after the show so you can be sick when I've seen what I've done here. But but no, it's great that the office has made this available to our audience there. So I don't want to, and people should understand this. We're very fortunate to have quality analysts on our show. They do a ton of work, and I don't want to give it away. That's unfair. But I will ask you can you just give me, because it's a sampling of the kind of what makes your top 31 and then what makes your top 8. Give us one conservative income side of the portfolio.
Certainly. So when we're looking for something conservative, something that's stable, but also still a growth stock, a name that I really like is Brookfield Infrastructure. The symbol is BIP.UN. So this is a large cap company. It's been part of our conservative portfolio since 2011, one of our long-standing recommendations. But over this 8-year period, we've actually put out 20 individual buy reports on the stock. So we continue to like it. It's a global infrastructure company, and what they do is they own and they operate assets around the world that generally produce very strong cash flows that are secured by long-term contracts and regulated rates of return. So stable business model. These include ports, toll roads, data centers, utilities. They just purchased an interest in a rail company in the U.S. But we like the idea of combining the relative safety of these stable assets with a company that actually has a strong track record and forward profile for growth, and that would be Brookfield Infrastructure. They pay a nice yield, about 4.5%, and income distributions continue to grow every year. And one thing that I've found absolutely amazing about this company is that since we recommended it originally in 2011 at about $14.50 per unit. And since then, they've paid $12, that's $14.50 Canadian. Since then, they've paid $12 US in income distributions over that 8-year period to their investors. So massive cash flow going back to investors, and the unit price is more than tripled over that period of time. So this is the type of business that we continue to like. We're optimistic on financial performance over the next couple of quarters and long term, and we think that it's one of those situations where it's not the cheapest stock on the market, but we still think it's a reasonable price relative to what you're getting.
Time's very short. I wanted to get to a completely different subject because one of the things I like about what Keystone does is that they also tell you about sell recommendations. So I was looking up the last time Ryan Irvine was with us. He was with us in April on the show, and he recommended a stock called Zynex, ZYXI on the NASDAQ exchange. And this is a great example because I got an update this past week or so from Ryan, and as did everybody who subscribes, by the way, everyone who subscribes, because on the show, you could have bought the stock at $450, $460 in that range. Well, he just issued a sell recommendation at $9, which is a spectacular return. But I also like the idea is that being told when the valuation isn't there any longer and merits a sell. So I love that side of the business, your business, Aaron.
Yeah, and that's a great example of a company. We actually recommended it when it was on the OTC. Then it graduated to the NASDAQ, and that really increased the exposure. But it really comes down to valuation. Great business, but trading at when we issued our sell recommendation, trading upwards of 30 to 35 times earnings per share, and we just felt that was too expensive for that size of a business and with the risk level. But we could get back in the future, but it's a lot easier to know when to buy a stock than when to sell it, and that's something that we definitely do. Is we're willing to pull the sell trigger when it's necessary.
Well, those are the great ones because they more than pay for any cost of the research, and that's the point. So I'll just remind people, if you're in that side of the market that says, hey, I want to know where the yield is, I want growth plus yield, and I want to be told what risk I'm taking, time frame, that kind of stuff. So go to keystocks.com, but click on the Money Talks offer, the Money Talks listener special offer, because otherwise you'll pay more than you need to. And it's a great deal. That's what we do here on Money Talks. Aaron, in the meantime, I really appreciate you finding time for us. I want you to go out. I hope I'll call on you by the end of the summer, but in the meantime, go out and enjoy the beautiful weather.
Yeah, you as well. Always great being on the show, Michael. Thanks a lot.